Good evening, ladies and gentlemen, and welcome to our class on how to profit from the cryptocurrency revolution. Now, tonight is our second webinar in our cryptocurrency webinar series. So we've already had a run by our introduction or our basics on cryptocurrency. And tonight we're going to be looking at ways that you can join the cryptocurrency revolution. And then we also have a class in understanding exchanges, because exchanges are a crucial part of the buying and selling of cryptocurrencies, and it also can make a big difference in your cost factor. And then we're going to be talking in our next class after that on wallets, because wallets are your bank. They're where you store and save your currency, and you always want to make sure it is stored securely and safely. And then the last part of our series, we're going to be talking about government regulation and its effects on the cryptocurrency and where we think that regulation and security will be in the future. So welcome to our series tonight on joining the cryptocurrency revolution. But remember, there's too much in this field to learn it all in one class. So the basics, and we have to get it down pat, is cryptocurrency is a digital currency recorded in a ledger of accounts and transactions between peers using a system of verification and encryption. Transactions are made by sharing public passwords attached to private and encrypted digital wallets. Each password relates back to a block of transactions on a digital ledger called a blockchain and represents a specific amount of digital coins. Now, that's a general explanation, but it really doesn't explain much to any of us. So let's try it again. Cryptocurrency is essentially a digital ledger of transactions secured by cryptographic codes that act as a decentralized currency, which can be exchanged between peers by sharing public passwords and related back to their wallets. Now, Bitcoin is the oldest digital currency in circulation today. It's been around since 2009. But the term Bitcoin relates to a very specific currency that works on a blockchain and is the granddaddy of them all. And it's almost like using the word Kleenex and tissue or Windex and glass cleaner. It's also become a generic term for the entire industry. So in tonight's class, we will be referring sometimes to specifically a Bitcoin, and other times when I say Bitcoin, we're referring to all Bitcoins and altcoins or all digital currency. And you'll be able to tell the difference, because otherwise I have to keep saying cryptocurrency over and over again, and cryptocurrency is a lot to say. So a digital currency is used to make payments of any value without fees. It runs on blockchain, a decentralized ledger kept running by miners whose powerful computers crunch transactions and are rewarded in Bitcoins. Now, last week in our last class, we discussed in detail miners and how they operate. So, a cryptocurrency is a form of digital money. And this is what we have to keep in mind. And Bitcoin works on a public ledger called a blockchain. To create Bitcoins, users must generate blocks on the network. Each block is created cryptographically by harnessing users' computer power. Now, Bitcoins are limited, okay? And a limit of how many Bitcoins can be created is built into the system, so the value can't be diluted. The maximum amount is just under 21 million Bitcoins. There are currently a bit more than 15 million Bitcoins in circulation. But just like any other currency, from the US dollar to the money in your PayPal account, currency primarily has value because we all agree it has value. Meanwhile, secondary factors include a limited supply and demand for it, use value in the economy that accepts it, and the exchange value because there's work behind it. So the same is true for cryptocurrency. It has little inherent use value, with the same being true for bank credit in a bank account. But nonetheless, the value it is valued in modern economy. We all agree it has a value for whatever set of reasons. Thus, it can be traded for other things with value, such as real world goods and services. Now, once we understand how it functions, and through the technology and how blockchain works and how it is secured, and that it is secured and it's very, very safe, we can understand that it's got value, it's got safety and security. And it's not just a network and technology, otherwise it'd just be theoretical. Fundamentally, Bitcoins derive their value just as anything else does because people want them. Like any other currency, Bitcoin follows the basic rules of supply and demand. Currencies have always been useful tools to make trade easier, enabling holders to convert goods into widely tradable commodities through sale. Now, Bitcoin derives its unique value from the fact that despite its lack of an official backing or wide acceptance, it has generated an ecosystem in which many people are willing to trade and accept it. So we've got a payment network, we've got a social network, we have people wanting this currency, and so we have buyers and sellers. The minute we create buyers and sellers, what do we create? We create supply and demand. So when buyers and sellers enter the market, there is an opportunity to make profits. And that's what we're all concerned about. So when it comes to joining this revolution and different ways to make profits using digital currencies, a lot of people are confused. There's a lot of questions we want to ask because it's different than a government-issued currency or different than a stock. You know, most of us, even if we're new to the markets, we have a general understanding what a stock is. Okay. Understanding Forex can be a little bit more difficult how you're trading one currency against another, but you still understand money. Understanding the value of gold and oil is not such a tough thing. We've learned a lot about it in school. Okay. So this is something new. So the question is, where do I start? What are useful keywords to look up and keep in mind when I'm trying to track down information? What are available helpful resources? Okay, because cryptocurrencies are something very new. So, does my coin of interest have a long-term plan? If you don't understand their yellow paper, at least read their white paper. What are the teams trying to achieve? Do they have means? Or have they already worked towards their goal? What are timelines and milestones? Why would you ask these absurd questions? Because digital currencies are all based on technology and the development of technology and the goals set by the companies that are doing the development for these coins. So it's not like a government, because you'd ask these same questions about a government if you're looking to invest in their currency. If you were looking to buy dollars, you would want to know everything there is about the economic situation of the U.S. If you're going to buy stock in a company, you'd want to know all about their stock. Well, if you're going to buy a cryptocurrency, you have to ask the pertinent questions. So, does my coin of interest seem like a well-marketed plan with no backup? There's lots of ICOs these days that just have pretty web pages and then they're shipped out to sell. So watch out for these. Are they available to deliver? And we'll discuss ICOs in a detail in a bit later. So there are lots of new questions you have to ask yourself. But one of the most important ones is, do you want short-term gains, long-term gains? What time frame? How would you exit and enter? Okay. Now, the thing is, the first place all of us really have to start is understanding cryptocurrency exchanges, because it's the primary place, or just about the only place, that you can exchange fiat currency, your dollars, your credit cards, your euros, to buy the digital coins. So in order to start investing, you have to buy them. Okay. And a crypto exchange also is a place that you can trade them. So the most common place where people buy and trade cryptocurrencies on exchanges. Exchanges are places where you buy and sell your cryptocurrency using fiat. There are multiple measures to judge the reliability and the quality of the exchange, such as liquidity, spread, fees, purchase and withdrawal limits, trading volume, security, insurance, and user friendliness. So regardless, and tonight we're not going to be talking about all the different kinds of exchanges. There's lots of them. We have a whole class in looking at and understanding all the different types of exchanges. Nor tonight are we going to be looking at wallets where you could store your coins. We're only tonight going to look at making money opportunities. So out of all these, I find Coinbase to be one of the best exchanges hand down. And I'm not promoting Coinbase. It's one that I use for myself. It has a beginner-friendly user interface and an unbeatable 100% crypto insurance. Now, as we get a hand in multiple exchanges, you may wish to buy from one exchange and sell on another to make arbitrage, gains when you spot an arbitraging opportunity. When you understand the different ways that cryptocurrency exchanges work, we have peer-to-peer, we have networks, we have trading platforms, but a lot of times you can find different exchanges where one exchange is, because one exchange is, say, selling a cryptocurrency at one price, another one is buying at another price, and you can find temporary adjustments. So you could actually buy your Bitcoins at one exchange and immediately sell them back at another exchange at a higher profit. Now, it's a small profit, but it's an arbitraging opportunity, and it happens quite often. Take note of two things if you wish to do so. Remember to factor in fees, and remember that the price could change when you are transferring your Bitcoins between exchanges, especially during volatile times. But you have to remember that Bitcoin or blockchain makes your transfers relatively quickly. Now, the US dollar tends to be liquid, so this happens less for it. But for other currencies, such as the Canadian dollar or the Singapore dollar, they may exist more arbitraging opportunities to exploit. Now, once you're familiar with crypto, you may want to trade on your stash in the hopes of increasing it. Okay. Now, this gets a little bit complicated because some exchanges, which aren't brokers or trading platforms like CFD brokers or Forex brokers, will allow you to leverage what you have in your wallet to buy or sell more crypto coins. So for the experienced Forex trader, this is nothing new. But for the new crypto investor, you may want to brief up on how to make leverage trades. Short-term trading takes advantage of incoming news to make a quick buck. If you foresee good news from an upcoming release of a coin, you may want to open a long and see how it goes. Remember, buy the rumor, sell the news. Act fast and be daring if you wish to make a profit. With the volatility we've been seeing in the crypto coins lately, and especially in Bitcoin, when Bitcoin surged all the way up to $5,000 a couple weeks ago, you might want to, if you had the opportunity to sell a couple, even though you didn't have the money, using leverage to buy back when it fell. And every time it bounces up, like today, I think we saw almost a $300 decline because it went from 36 to 42 and then came right back down. So there are chances that you can buy these on dips and sell back on peaks. and you can use this trading on margin with your exchange. Because trading on margin with your exchange means you have to own some of those cryptocurrencies in that exchange account. But there are two ways to deal cryptocurrencies. You can buy them in the hopes of selling them at a profit, or speculate on the value without owning them via CFD trading. Okay. Now, trading in CFDs is much different than trading on a crypto exchange. In a crypto exchange, you have a Bitcoin account, and you have Bitcoins in there, and they might offer you 1-to-1 or 2-to-1 or 3-to-1 leverage. It means if you have one Bitcoin, you can leverage it up to 3 Bitcoins and buy or sell. But it's all based on you having this exchange, and this exchange having those Bitcoins or whatever currency you're flipping it in. Where CFD trading allows you to take what's called a contract for difference, which is done, you don't ever have to own any cryptocurrency, and your wallet is your account balance, and your account balance is whatever your local currency is or whatever you set it up, because you're never taking ownership. So Forex and CFD traders have got wind of the hype about the phenomenal returns, and now they too are demanding access to digital assets on trading platforms. So most of your larger CFD platforms are now offering cryptocurrency. Margin trading on cryptocurrency exchanges remains the most popular, but CFD trading is growing by leaps and bounds. So first, let's break down what is margin trading, and then we're going to go over and break down CFD trading. So in a nutshell, margin trading is basically borrowing money from your broker for trading. And whether you're trading on CFD or you're trading on an exchange, you're trading on margin. But a CFD platform might offer you up to 500 to 1, not 500 coins for each coin you own, up to 500 to 1 on the balance in your account. Most platform providers offer a leverage of 1-to-1 or up to 2.5-to-1. That's an exchange, meaning that if you can borrow up to 2.5 Bitcoins for every 1 Bitcoin you have on deposit. So for beginning traders, I suggest changing your leverage right after you set up your account to 1-to-1. Keep in mind that by borrowing funds, you'll be subject to interest charges from 10 to 13%, which are automatically factored in when you close your position. Now, this only happens in margin trading with exchanges. It does not happen in CFD trades. CFD trades, there is no interest charge, because there you are just in a contract for difference and nobody actually owns the currency. Here, you're actually borrowing these crypto coins from your exchange, and the exchange must have them. Okay. Now, if you're inexperienced, please listen to my advice, or you can get burnt badly. Although 2.5 leverage is pretty decent, you can remember the other side is it magnifies your losses. So, for example, if you use 2.5-to-1 leverage and short sell your entire account from $800, but the price goes up by $800 at a 2-to-5 leverage, or equal to $320 to $1,120, you're going to lose all of your Bitcoin in your account because of a platform stop level and margin calls, which can stop you. Okay. You can place stop losses in a leveraged account, which means if the market's moving against you, you can put a stop in it. If you put the stop and it dips down to where you put your stop, you're going to get your position closed out, and the coin can still go in your favor. Now, of course, this can be easily managed with a good trade size and risk management opportunity, but we'll cover this later. So let's try it by example. Let's say we deposit 10 Bitcoins into our trading account using a one-to-one leverage. And we think that the general trend is going down. And we want to place a short sell to capitalize on the fall. You'll place a limit order, enter your price at say 850 for a total of 1 Bitcoin, and click the margin sell button. Let's also say from technical analysis you figure out that the next support level is at 760 and then 700. So at the same time you can also place a limit buy order for something like 0.5 of Bitcoin at 760 and a half of Bitcoin at 700. Because when you're doing margin trading, you have to do the opposite to close out your position. Okay. So what you have to do is you have to pre-buy a position. So you're selling your currency right now because you're hoping the market's going to fall. Now, you want to figure out where you're going to put your orders, because you want to sell short because you think the market is going to fall. So on top of that, if you think there's a strong resistance at 900, I feel that it may break up to 900, but not beyond that. So you can also place a stop buy order at the 910 or a trailing stop order for $60. This means you're protecting yourself from both sides. It's almost like CFD or Forex trading, except it's margin trading on your broker. He offers many different order types, but it's very simplistic ordering and it's very restricted. Okay. For traders with a limited amount of crypto resources, Bitcoin and altcoins, there's an option of margin trading in order to add leverage to the investments. This, in fact, increases the amount invested without having to actually hold the asset. It is important to mention that margin trading is not recommended for everyone and is a very high risk. Now, all of that sounded a bit complicated, didn't it? It was meant to be that way. Because a trading platform, a trading exchange was never developed for leverage trading and for trading in digital coins. Okay. Now, a more attractive way is through similar to Forex trading, and it's using CFDs. Okay. And this will allow you to trade the pair where you are trading the Bitcoin against dollar, US dollar against Ethereum, Bitcoin against Ethereum, but you don't have to buy them. You don't have to sell them. You're not getting involved in the ownership end of it. Okay. So say Bitcoin is selling it against a dollar, because when we say Bitcoin's at 36.50, that's in US dollars. So if Bitcoin was trading at 36.50 when you got onto your CFD trading platform, that means it's Bitcoin / US dollars. Your broker offers you up to 500 to 1 leverage. So that means with $1,000 in your account, you could technically trade up to $500,000 of these coins. So you could technically own how many Bitcoins? A Bitcoin's about at $5,000. You could trade a lot, but that means you could lose a lot. But you don't have to get involved in that. You can say, okay, I want to trade Bitcoin, and Bitcoin's at 36.50. How much do you have in cash to invest? And it'll tell you right on the screen what your leverage is and what your deposit will be. It will also ask you at what point do you want to protect yourself. In other words, if Bitcoin falls, moves against you, at what point should that broker automatically close your position to stop you from losing your shirt? And when it goes up, is there a profit level that you'd be happy just to take the profit with? Now, your account is in, you live in London and your account's in pounds. You never actually buy a Bitcoin. You never sell the US dollar. All that you're doing is saying, okay, I opened this trade at 36.50 and I did this for $36,500 of Bitcoin or 10 Bitcoins. When you close it, Bitcoin's at 36.75. The difference between 36.50 and 36.75 is $25. You had 10 Bitcoins, so you made $250 profit. Now, there are things called spreads that you have to cover, but they're small increments. So a CFD is a derivative financial instrument that mirrors the movement of the underlying assets, such as indices, energies, commodities. As it is a derivative, traders do not actually own the underlying asset. They just use them to speculate on price movement. So it is a very good, much easier way than trading on an exchange. There's also an exchange. You've got to pay the exchange fees, the exchange rates, which are much higher than brokerage fees and commissions, and you have to get involved in storing your cryptocurrency in wallets, understanding exchanges, exchange fees, and everything else involved. Now, you would have heard of Bitcoin and altcoins. How is the naming convention started was back in the days of 2011, and forks of Bitcoin started to appear in the market. The forks and clones each aspired to serve a niche area, aiming to be better than Bitcoin. Since then, countless new cryptos have emerged, eroding away at Bitcoin's market cap dominance. These altcoins, which we know as Ethereum, we know as Litecoin, we know as Dogecoin, there's actually almost 1,000 of these coins in the marketplace. The fact is, most of these coins have virtually no liquidity. They have no availability to be traded because there isn't much of a market. But these altcoins are gaining market share at an alarming rate. 10 times or more growth has been observed in a short time span, as much as 6 weeks. Most of these are being generated today by what we call ICOs. And everybody wants to know about ICOs. They're the headlines of all the papers. Every government body is looking at them. It's a new business model in the crypto network. Okay. Now, before we start talking about investing into cryptocurrencies and the possibility of making some profit along the way, we do need to discuss ICOs. And don't confuse these with IPOs. So let's get to the point. What in the world is an ICO? An initial coin offering is a transaction type designed to help spur and launch new cryptocurrencies and give them traction. Essentially, it's a fundraising tool designed to boost the newly born currency into the online world. The idea is that you invest currently launched cryptocurrencies into the new currency you are favoring in an exchange for future crypto coins of the freshly launched or to be launched currency. Now, most cryptocurrencies today, most ICOs, are using Ethereum. Means you have to go through an exchange, use your US dollars, your credit cards, or existing Bitcoins, convert them to Ethereum, and then sell them to the ICO in exchange for the currency that the ICO is offering. This gets very complicated and complex because not all exchanges and not all wallets will store all coins. A lot of wallets only store Bitcoin. So if you have Bitcoin in your wallet, but you don't have, your wallet doesn't store Ethereum, you've got to take your Bitcoin out to an exchange, convert it to Ethereum, move it back to another wallet and save it, or move it from there directly into the ICO. So you have to be careful because sometimes you're paying exchange fees and rates all the way down the line. Now, once you've got it into that and sent it to the address for these exchanges or set up a wallet with this exchange, it's only a promise. You don't own stock in the company. It's not like buying penny stocks and hoping the stock soars or buying a newly started startup. You don't own any rights, and you also don't own any stock. It's somewhat, you give the launcher some Bitcoins or Ethereum, and you get some of their future unicorn, assuming that those don't exist yet. Okay. So in other words, I could set up tomorrow Berrycoin. And I could sell you, all I have to do is set up a network, get a couple exchanges, get some miners on board, and I can start selling you Berrycoin. And I tell you to go use your US dollars or your credit card or your euros and go buy Ethereum and then send me your Ethereum and I'll send you back based on the value of Ethereum. So many promises, so many tokens for this Berrycoin that doesn't even actually exist yet. So in the fiat world, most financial institutions see these ICO transactions as unregulated investments of cryptocurrencies where users can make Bitcoin or other digital currencies. The key word here is unregulated. Unlike shares or traditional IPOs, ICO coins, the representation of your investment into a certain digital currency startup, aren't linked to any ownership rights and thus can be traded or exchanged at will. In the fiat world, this is a huge no-no. So you see, most of these ICO coin tokens are designed in a way that marks them as safe software pre-sale tokens. So essentially, your ICO coins are no different than a video game token that you have bought before it launched. The main reason many developers choose to address their new currency in such a way is to avoid paying all the expenses that come alongside legal sales. Okay. So in the real world, companies can always secure funds by approaching angel investors and venture capitalists. But by doing that, they would have to give away a share of their equity to them. What companies wanted was to get a lot of funds without giving away equity and ownership. And the only way they could do that is by going public. So how does an IPO work? In an IPO, a private company basically decides to put up its private shares for sale to the general public. Anyone, anywhere can buy the shares of the company. Initially, these shares are dirt cheap, and if the company hits it big, then there is a chance of your shares ballooning up to exorbitant rates. We have all heard all the stories about masseuses who became multimillionaires because of our 500 useless shares of stock in Google matured over time. This is an IPO, not an ICO. Some people started wondering what would happen if we used the same concept but put it on a blockchain environment. This is what gave birth to the concept of ICOs. ICOs are pretty similar to IPOs, but with three major differences. Firstly, the ICO was decentralized with no public authority. Secondly, the ICO lacked the tedious red tape that most IPOs were bogged down with. And finally, they were unregulated, while IPOs have always been under very heavy regulation. Now, there was a problem that blockchain-based companies were facing when it came to ICOs. In an IPO, the investor got shares in return for their investment. What would a blockchain company give away in exchange for capital? They had to invent blockchain equivalents of shares, and that was when they came up with the idea of tokens. An ICO is a sort of mixture of an IPO and a crowd sale. When you are interested in a particular project in the blockchain, the way you can gain access to it is by sending the development team some of the money, which is usually paid in Bitcoin or Ethereum, and getting an equivalent amount of token in return. Tokens have gained even more prominence since the advent of Ethereum. Now, if you don't understand how crypto coins are developed and how crypto coins are made and named, you missed our other webinar, which will be repeated last month. But you have to understand how all of these uses blockchain but add new technologies or different types of, and they're all forks off of the original blockchain technology. So they're all sisters of Bitcoin. They all have the same DNA, but some have better DNA, some have different DNA, some have different combinations, but they all fit around the same thing. But the fact is, it's all code, and it's an easy code. It's not a complex code to develop a coin. It's more complex to develop the exchange network, the miners, and everything else. And finding something that's going to give it value. Because what all digital coins come down to is their value is only based on the social network that's built, or the community is built, of buyers and sellers who want these coins. So even though a company raises $1 million by putting these tokens out there, there may be no way to ever trade them or get liquidity back. So your tokens could technically go up in value, but unless you can find a buyer for them, it becomes very difficult. And there are two categories for all these tokens fall under. There's usage tokens and work tokens. Usage tokens, these are tokens that act as native currency in their particular environment and can be exchanged for other tokens or fiat money. Ether is a great example of a usage token. In short, usage token is currency. Now, what happens is Ethereum was launched as about the first ICO. And what happened was it was so successful that everybody else wants to get in the bandwagon, which is allowing, I can't tell you how many companies I read about in the financial, but every day, useless companies I wouldn't even have been involved with or invested in as a company, now are offering offering ICOs. And it's just, I mean, it's just like, all you have to do is have a development team and you can have an ICO going tomorrow. Because it's not like doing an IPO where you have all this government regulation, months and months of paperwork, lots of things that have to go on about it, government scrutinization at all points. You know, most people, when they want to run an IPO, they have to have all their board of directors, even their resumes of all, I've seen companies who dump their VPs, their presidents, their directors, and everything else to get people with acceptable, big resumes, even though they're brand new to the company, because they will look better in an IPO to the public than the guy who's been working, 5 years building that company up. This doesn't happen in these ICOs. They don't need to list anything. There's no pre-described government-controlled format they have to be in. So that you have gotten, now that you've gotten a crash course on what tokens are and how they work, let's do some deep dive on ICOs and why, for better or for worse, people are calling them the new gold rush. A number of millionaires that ICOs have made in the last year or so is staggering. Over the past 12 months, ICOs have raised $600 million as opposed to $140 million by established venture capitals. That, in mind, is boggling. So, what is it about ICOs that attracted so many investors? ICO is the rock star of the investment world. It is the untamed wild genius wearing a torn t-shirt and baggy jeans, living among a group of suited, wearing snooty businessmen. Yes and no. What happens? ICOs allow you and me and everybody else to get involved in it because it's using basically crowd share. Most of us can't get involved in IPO. The minimum investment, we can't even get to a broker that's offering an ICO. And then when you do, they're looking for a minimum before a stock goes public of $100,000, $200,000, $300,000. There's also nothing like leverage or margin. So here we go, where ICOs, you can get involved for small amounts of money and put it aside. I was using an example to somebody today that we were talking, if your grandparents gave you $1,000 for your graduation from high school or your graduation from college, it's found money. To stick it in some new digital currency out that is just starting in the hopes of 10 years from now or 5 years from now, it'll skyrocket. Well, hey, it's worth a gamble. Now, think about this. Anyone with a good idea for a project can gain massive financial backing from a community without being bogged down by politics and endless red tape. The idea that anyone, anywhere can get the financial backing they need in an unregulated manner was a welcome idea for all. No longer will investments be reserved just for the uber rich. Anyone can gain funds to make their dream a reality. Now, again, keep in mind, it is high risk. It also takes quite some time to pay back. Look, we had all the crowd sales. Then I got involved in all those startup companies where you could buy, be a participator to give money to launch a product that, they raise the money. I used a company called Indigo, but like Kickstarter and everything else. In the long run, half a dozen of these projects I bought things in never delivered the product. Or when they did, it was a piece of garbage. But the fact is, I had no legal route, no recourse. The companies that didn't ever finish their production, there was no recourse. There was nothing you could say. In fact, most of them ignored you entirely. And this is what it is about ICOs. There is no guarantee of anything when it comes to these. So if you want to grab into this cryptocurrency revolution, might be buying a Bitcoin, or, well, it's kind of hard to buy Ethereum or Bitcoin at the price it's reached to, but maybe buying one of the newer, more popular currencies, the ones that have been around for a while, that are developing better technology, like maybe Ripple or Dogecoin, or the ones that have, Litecoin, the ones that have stayed to come. They don't have a great deal of liquidity, and put them away. Do you want to trade from an exchange? I don't know. I don't feel comfortable with exchanges. Even when I exchange my Bitcoin for whatever there, I move them right to my wallet. I don't feel comfortable. Mt. Gov was an exchange. Most of the failures you read about in the marketplace, because Bitcoin or digital coins are very safe. It's the exchanges that aren't. Okay. And therefore, it's CFDs are very interesting. They're the fastest growing investment vehicle in the marketplace today. But they're for short-term, high risk, not high risk, but short-term investments. But it's a way to take advantage of what you think the coins will do up or down without having to pay exchange rates and fees. And lastly, ICOs are the hot new thing out there. Maybe you want to put a couple of coins here or there. But there's lots of opportunities to get involved in this whole new revolution. But first, you have to learn the basics. So on that note, we'll say goodnight to you all. Thank you very much for joining us. Have a great trading week, and thank you for supporting investing.com. Have a good night now.